Turning now to the economy, today would have been the day we got September personal income and spending data, which includes the Fed's preferred inflation gauge, the PCE. But this week's earnings reports have given us some clues on the pressure consumers are facing, especially the younger population. Chipotle saw a broad pullback in all income cohorts, but the company said the 25 to 35-year-old group particularly is challenged. The stock got punished, losing nearly a quarter of its value this week. And our next guest says the struggles the younger population is facing provide a signal for the state of the overall labor market. Joining me now is Chris Wheat. He is president of the JPMorgan Chase Institute, which is out with its own report on personal income. Chris, what do the struggles of the younger set signal?
Thanks for having me on, and I think it's really helpful to have this conversation. We have been looking at income growth for a while to really understand the take-home income in particular that people see. For the year as a whole, we've really seen quite tepid growth, but in the last couple of months, we've seen that start to come down. And what we drew attention to was those younger consumers where we're seeing less strong growth than we would usually see. Usually those young workers are seeing the strongest growth, quite a gap between the youngest and people farther along in their careers. We really have seen that tighten a bit in the last couple of years, suggesting less growth for those young people and less purchasing power as a result.
So what are the implications for the economy then?
Well, I mean, it's one of many signals to make sense of what's happening in the economy. Income is where I think things really start. That's where the money's coming into the house. It's where you're going to spend the money from. Of course, there's saving. Of course, there's investment. In other places, we've actually seen more investment by young people, but even that could be a sign about the increasing prices of other assets, such as housing.
What about the older Americans and perhaps the better heeled who have stocks in their portfolios and have been doing quite well? Is that carrying the economy overall in a way that's equal to or different what we've seen in other cycles?
Well, I mean, you're right to draw attention to sort of the differences between the younger and the older, higher, lower income. Those people that have more exposure to assets in general, be it through stock ownership or housing assets, they're getting the benefit of all these asset price rises. If you don't have those things, it means less to you. So it's definitely a thing to think about as you're trying to understand spending differences across groups.
What does it imply? I don't know if you guys looked into this at all for the fourth quarter. I mean, there's been a lot of spending among the young, certainly the working class, that's credit driven, and that can reach an end for some at some point. How does that look overall versus how it's looked in the past?
Well, when we try to think about what's going to happen forward, and honestly, mostly we're in the business of explaining what's happened more so than predicting what's going to happen. But it does kind of give us some sense of what some of at least the labor market dynamics are looking like, both from an employer point of view and from an employee point of view. When you see that softness in income, when you don't see the kind of behavior that's consistent with people moving between jobs, kind of the things you like to see in a robust labor market, it certainly makes you think that employers and others are maybe uncertain about what's going to come and making investment decisions in a more cautious way that can reflect that.
Income isn't growing as much as it has at other times, particularly for the young, but people are largely keeping their jobs. I guess that helps?
All else equal, yes, but I mean, for some people, changing jobs is the way that they see income growth. Like a lot of that income growth comes as you move from a job that maybe wasn't such a good fit to one that maybe is a better fit. So like no one wants to lose their job, but when people are proactively feeling good about the economy, finding better matches, that also leads to that job turnover, and sometimes that can actually be a good sign for the economy.
Difference between losing your job and leaving your job, right. For sure. Chris Wheat, thank you.